breaking through the noise as a brand, the shift in seed investing in CPG, balancing growth and risk, and navigating growth equity markets in 2025. This week on the show, we have Asher Hochberg, partner at Rootspring Ventures and previously general partner at consumer fund CircleUp. Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We follow the flow of money between founders, investors, lenders, and everyone else in the ecosystem to ultimately answer the question, is D2C and CPG still a good business? Hope you'll enjoy the show. Asher, we love hot takes. We're going to dive straight in. I know that's something that you feel strongly about is, what are the brand or company attributes that break through the noise of everything that you're seeing on your desk that really gets your attention?
Sure. Yeah. I actually, as a consumer investor, I really hate the question, like, what's the new trend or fad? Because I think it makes us all look a little bit like lemmings and just go to the next thing, the hot thing you see at Expo West or wherever. And so what I actually look for, that hopefully others are looking for too, is I'd say blurry industry categories that are adjacent to huge categories. An example would be, let's say, hydration powder, which was not a consumer staple for a long time, yet it sat right next to hydration beverages, Gatorade, whatnot, which is a huge category. So, around 2015, Liquid IV took this blurry category by storm, and now it's a household name owned by Unilever. Another example would be what I would call a preventative health clinic, which, as someone who grew up in the 80s and 90s, you had your doctor's office, you had your gym, that was kind of it. And now there's kind of like a third place that's devoted to improving your health span, with validated therapies, but it is mostly out of pocket. And an example of a company that's done really well and kind of been the leader there is a brand called Restore Hyper Wellness. And then another example, and this last one, is what I would call a remote first IVF clinic that I recently invested in called Sama. IVF is an incredible life-changing product/therapy, but the patient experience is incredibly poor. And no one really thought to try to do a lot of the steps that's required to go through IVF at home. Now there's new technology and actually at-home ultrasounds, which makes the service a lot easier to pursue. And yeah, there's just some great novel business models and products getting created next to really huge categories that I feel like are missed by maybe traditional investors.
I just want to make sure I understand and we can clarify for the audience this distinction between the blurry lines around the incumbents versus a trend, and make sure the founders don't get caught up in just following the trend, but are making the distinction that you are.
Yeah. I mean, I think you have to understand that consumers might not always be there right now, and that there is a leap that you're going to have to make that a consumer, okay, if somebody is buying product X and product kind of Y is right next to it, there's a good chance that if you educate them, they'll maybe replace X with Y a little bit more over time. And you just are constantly looking at that. So that's why, repeat customer rates, which we'll talk about, are so important, because you really want to see if somebody just experiments and tries something once that's new, will they buy it again and again and again? And that's like kind of the best sign. Kind of going back to your other question, what irks me a little bit about some investors and founders is the desire to kind of replicate what's worked recently. So a founder may see the success of Olipop or Siete selling to Pepsi for $1 billion and say, I want to do that. I guess maybe I'm just more contrarian. My bias is the opposite, and to go away from that. That ship has sailed. It's my job to find a new product or service that can scale that's different than what came before. And that include in this kind of bucket companies with novel approaches to business models. So this could mean like a B2B to C business model with a really interesting partnership or revenue share structure, or even a more specific example could be, and this is an actual company that I've invested in called Ladder, is actually building an online community. And it sounds really niche, but it's actually become a quite large company, an online community of people who go to the gym regularly, know that strength training is important for longevity, but really don't know what to do each day and don't really want to pay for a personal trainer. So again, a lot of qualifications there, but that's actually a very large number of people. So this company kind of takes the best elements of, I'd say, YouTube and Facebook in terms of high quality coaches and online education and a community element like Facebook, and kind of combines them in a really novel way to manufacture motivation. So again, it's like a completely new way to think about exercise or app or your gym. And that's what's really interesting to me. And no one's really done that before, as opposed to just, go sell widget X at, Whole Foods.
Yeah. Is it possible that, again, for founders thinking about what they're building, if we're all reading about it in an exit press release, it's probably 5 to 7 years too late. What you're talking about is, about the next 5 to 7 years. And I like that. I really like that framing of you're next to the core incumbent that's got 90% market share, but that's going to change in the next 5 to 7 years. And it's going to move through that blurry line to the emerging categories.
Yeah, absolutely. And I think you have to think creatively about what's a blurry category and what's just a fad or is never going to take off. Like, people love to talk about, like mushroom protein or something, right? And so somebody might say, oh, well, that's a blurry line. It's not that many people really into mushroom protein. It sits next to protein, which is a huge category. So why isn't mushroom protein going to take off? You have to be kind of thoughtful around, okay, like what does reality say about people's taste preferences and all that? So it's not as easy as just finding an adjacent thing. But I do think consumer behavior is changing. And happy to get into that, or get into how I got into all this in the first place, wherever you want to go.
Yeah, no, let's do that. Why do we love Numeral? Well, here's the good, the bad, and the ugly. The good is that over 1,000 e-commerce stores just like you use them for sales tax compliance, including some pretty big brands like Ridge, Emmy, Nomad, and Graza. The bad is that none of us got into this to spend a ton of time on sales tax and admin, which is why Numeral is able to help you in 5 minutes or less get full coverage, deal with registrations, ongoing filings, and compliance. It just happens in the background. And the ugly is that not a lot of store owners know that sales tax is actually personally guaranteed. Said another way, that the states could end up coming after you personally if you're not on top of it. Even a modest $5 million store owner could have nexus in 20 or 30 states. Again, Numeral helps you stay compliant, and they even guarantee their work. That's why we love them. Go and check them out at numeralhq.com. That's numeralhq.com. I think you've got one of the most rich backgrounds in our industry. You've done CPG credit, you've done growth equity, now you're focused on seed. Why do you think seed is the best place to put dollars?
Yeah, and again, this is all in consumer, which I kind of define broadly. I think a lot about supply and demand to start. I'd say for the 10 years leading up to 2022, and certainly for the 5 years leading up to that year, there was an oversupply of equity capital to early stage consumer companies. And I'll define that as early stage as pre-seed through Series B. And so oversupply and poor results actually for a lot of early stage equity investors for that vintage, which is unfortunate. Personally, during that time, I was more of a credit investor because I thought the credit end of the spectrum was more interesting. And the risk-adjusted returns were a bit more attractive. But then came 2022 and two major shifts happened. First, the interest rate cycle completely shifted. The risk-free rate jumped. Institutional limited partners became very reluctant to invest incremental dollars in venture capital of all types. You get into that. And second, ChatGPT launched in November of 22 and launched the AI era. And AI's promise is unbounded, and many software VCs who used to cross over into consumer occasionally have now fully retreated to just kind of focus on AI. So this leaves a kind of a big hole. And there's a dramatic scarcity of capital for early stage consumer brands since really 2023. That's still ongoing, I'd say. And so just like Buffett says, when others are fearful, be greedy, like I moved, kind of stopped doing credit stuff and started equity and Rootspring, which is my own fund. And I also work with some other funds as well to write larger checks because I thought it was such a great time to get into the space after watching the space from a different lens for the last 10 years prior to that. I don't believe we'll ever get back to kind of the supply of capital levels we saw in the 2018 to 2022 go-go years. And I think that's good for the ecosystem and founders. But I'd also think it's important to let's kind of zoom out. So that's a little bit pessimistic, but I'll say let's zoom out and kind of focus on what is actually the problem that a lot of these companies are trying to solve. Like, what is the core problem? And I would define the problem as an epidemic of chronic health conditions facing the Western world, and a healthcare system still overly focused on sick care versus preventative care. And that's a big statement. And not every consumer company is going to be like laser focused on that. But that's kind of what interests me a lot. I'm fascinated by biology and how little we know about ourselves. It's kind of crazy. You have millions and millions of scientists and doctors out there in the world, and we're still just kind of understanding how the human body works. And my translation is like, how can I invest behind companies that people are consuming every day or every week to optimize their performance so they can become a better person or whatever they want to do in life? So I have a more traditional finance background, and then I got into early stage consumer back in 2015 as an operator. And at that time, I said we were in the early innings of, that's a baseball analogy, like the first, I'll call it 10% for any Australian audience, the multi-decade trend. And so this, I think is still true. It's been fascinating to me this is a little bit of a rant, but I enjoy talking about this. It's been fascinating to watch the Make America Healthy Again movement take shape, and the fact that the Callie and Casey Means podcast episode with Tucker Carlson was the single most shared podcast of 2024 per Apple. And that tells you something. And if you actually listen to that podcast, the Means siblings are honestly talking a lot about a very crunchy, Whole Foods, hippie, buy organic Whole Foods. Like that's like a core of what they're saying. They have other stuff, but like the bulk of it is just eat healthier, more nutritious food. And that's just fascinating to see kind of that whole world really take the flag there. So yeah, I think there's natural tailwinds behind, quote, the problem, as I've just outlined. I do think there was an oversupply of capital addressing, quote, the problem for a long period of time, which led to just a bad ecosystem to really earn returns and to cut through the noise because there's just so much noise. But now I think it's very different. And what hasn't changed, I would say, is the ability as an investor at the early stage to get your money back for your investors. That's always really important. And the M&A activity for incumbents in consumer, I think, is still very high. I'd argue that per dollar invested, you're probably getting more M&A back than in, let's say, B2B software or AI, definitely. So from an actual true LP perspective, I think they should think about that because the liquidity in software has been quite low, and distribution DPI, whatever it's called for VCs when they get their money back, is really low because there hasn't been a lot of liquidity. But in consumer, I think that's actually different. And yeah, there's always a plan B, which is private equity. And so a true consumer brand shouldn't invest a ton in CapEx, should generate a decent amount of free cash flow, should have a low price point, repeat purchases, which is a really great setup for a financial buyer.
There's so much I want to dive into there. Let's start with, what does seed mean in 2025? Because I think, I've been forwarded decks that say, hey, we're a $10 million business raising $10 million revenue bootstrap business raising $2 million seed. And then I've also seen the hey, we're pre-launch and we're raising $2 million seed. Are they both seed to you, or what does seed mean in 2025?
It doesn't mean anything. The word doesn't mean anything. I use it as a helpful framing. I still think there's the world of pre-seed, just because so many people use seed the wrong way that I think you kind of have to sometimes say, is this kind of pre-seed? I would just think of it as it's the first time you're raising a lot of money, or the second time you're raising a lot of money, and a lot could mean 500K, 750K, I don't know. But I do kind of think of it as how many raises have you done? And there's no magic to it. I think a lot of people say, oh, when I get to the A, I have to show this or what. I think when you get to your second really large capital raise, you have to show good metrics over the first. If you're doing the first one, it's the first, then it's kind of like a PowerPoint exercise and you're taking a leap of faith, whether that's pre-seed or seed, whatever you want to call it. Then the second time you raise, you have to show what you've done with the capital from the first raise. You have to be a good allocator of capital as a founder. And maybe your revenues are still low, but you have some awesome partnerships in the pipeline and you have some really good data to show on a very low revenue base, which means, hey, let's raise a lot of money and pour, gasoline on this or not. So yeah, I do think that's basically the number is actually more important. I wish they labeled them 1, 2, 3, 4 as opposed to like these random qualifiers.
AI. Everyone's talking about it and you're worried you're getting left behind. Meet RichPanel, an AI-first customer support platform that's built for one thing, making support faster, smarter, and cheaper for e-commerce brands. Something you can actually feel smarter about using. RichPanel combines a unified inbox across email, chat, and socials, a customizable self-service portal that customers actually use, and Sidekick AI, powered by GPT-4, which learns from your past tickets to suggest on-brand replies. Does it actually work? Well, with RichPanel's guarantee, you get guaranteed 30% cost savings when you switch from Zendesk or Gorgeous, 30% automation to reduce your ticket volume, and a no-risk guarantee that if RichPanel doesn't deliver those results in 60 days, you get a full refund. That's why top brands like Ridge Wallet, Jones Road Beauty, and Pella Cases are already using RichPanel to save hundreds of thousands in support costs. Time to start letting AI work for you. Head to richpanel.com and start your free trial today. Real savings, real automation, real AI that actually works. Let's dive into how you think about capitalization on a company's growth journey, because I think this is actually a really nuanced and often misunderstood topic. Presumably, as an investor, you want to be putting as much money to work into a company that is growing enterprise value organically without hurting its enterprise value by overfunding it and them using it poorly. But yeah, this week I met a founder that had gone from 0 to 20 million in the past 3 years, 25% plus EBIT that converted to kind of 20% plus net. It was just an amazing business. And just didn't need to raise money. And I was like, wow, like I'd bet that there are investors that want to give you money, but he's like, I'm just accruing cash every month. Like I'm nervous about overhiring because I don't want to break the business. How do you think about different capitalization journeys for growing companies?
Yeah, I love that, by the way. I wrote a blog piece called Capital Efficiency Heroes because there's like these unsung heroes out there that do that. And you don't read about them anywhere. They're not in any of the Axios blog posts on fundraising or anything, but they're just kicking ass and no one knows about them. So I wish more of those stories would be told because I do think they're telling the other side of the equation as opposed to just like, oh, we've raised X billions of dollars, and we're off to the races. So the answer to you, I'd say the boring one is it really depends on several factors, but I'll give you the cliff notes. In the absence of any data, I would advise a founder to optimize for profitability and strong unit level economics over growth. Of course, growth is important, but too many companies have grown to a sizable scale, even to like a public company scale with poor unit level economics, and no amount of growth can solve poor unit level economics. So the advice here, without knowing more, is to raise as little as possible out of the gate and to try to show some early indications of capital efficiency or profitability. And hey, maybe you never need a raise and there you go. If I could look at some data, I would first focus on repeat customer rates and then on fully loaded gross margin. Repeat rates are a really good measure of demand, which I'll kind of define as product affinity or efficacy. And gross margin is a measure of whether consumers actually place a monetary value on your specific option versus others. And an example I love to use is I love walnuts. I go to Costco and get my walnuts there. And Costco sees a lot of repeat customers from Asher, customer purchases, but I'm pretty sure the margin's pretty darn small. And if another place offered walnuts slightly cheaper, I'd probably go there, depending on how far the drive was, depending, because walnuts store pretty easily. So I think you need both like repeat rates, and a margin to actually show that I value that walnut, different than just a commodity. And so I would say if repeat rates are meaningfully above average, talk about that, and there's a robust margin, then it's probably a good strategy to actually burn cash flow for some amount of time to grow faster. That's so, with those, both qualifications there, I think that's viable. On the appropriate amount of equity to raise, it really depends on how believable it is. The company may hit, let's say 50 or 100 million in revenues. I'd call that like escape velocity. Like once you're there, it's much more likely you're going to survive and succeed. And if you're not already turned cash flow positive. I'd love to see the first round of equity capital. Again, this is kind of 1, 2, 3, but the first of, on equity side, call it less than 2 to 3 million. The second, somewhere in the 5 to 10 range. And the third, maybe like 8 to 15. So, without knowing more, I'd say try to raise in total for the first 3 raises, less than 15 to 25 million of equity to get to an escape velocity of 50 to 100 million of revenue. And then one last thing I'd say on the debt side, having been a lender in the space, I see founders get kind of excited by debt offers when their runway is low. And I'd say that's a really bad option. When your runway is low, debt is not a substitute for equity, and it's just going to cause you more pain. You really should try to raise equity, even though debt might be on the table and people might be willing to hand you like $1 million. It's like, it obviously comes with strings attached, and it can just make your life a lot more miserable than if you spent the extra 3 or 4 months trying to raise the equity.
Let's talk about retention. I think on this pod, I had a debate with a CPG D2C marketer, Andrew Farris, about retention curves. And he kind of made a similar point to you that when he's inside a customer file or at account that has really strong repeat, he's like, back up the Brinks truck, like, let's go and let it fly because it's predictable. You can just make the math work, and that's your edge because you've got such a strong retention curve. My counterpoint to him was like, does that feel risky? And to use kind of maybe a outdated analogy, I remember when Groupon had their LTV out to, 5 years because it was so popular and everyone was going to use Groupon forever until they didn't. And then the retention curve fell off a cliff and then the CAC math just imploded. Is that a concern for you? Like how aggressive, like even in the face of strong retention to signal product efficacy and customer love, but preferences change, competition increases, all of these eat at retention curves. Like how aggressive can and should a company be?
The short answer is I don't think that aggressive. I always think, it's quality over quantity and to be patient because, I'm sure a few people bought a second pair or third pair of Allbirds, but now it's unfortunate. And so, I think you have to be really thoughtful about the way the brand actually is coming across to consumers. And if it's just too in your face, bad things can happen. And I think some categories or some types of products are just much more fad driven, like apparel is just that way. You just constantly see shifts in apparel. Just fashion is kind of like that. So seeing Vuori at a $5 billion valuation makes me a little concerned because I like Vuori. I don't want them to go away, but I just hope they find a good home one day. I do think you have to think about the product and how fickle consumers may be for something. I do think like the lower the price point, the more comfortable I would be because you're not asking for a dramatic shift in when things get tough. And with a lower price point, the fact that somebody can come undercut you at a much cheaper price point is more unlikely. So the more discretionary, higher priced items I would be more worried about relative to a lower priced thing. I think anytime you look at retention curves, you always have to put in place what is the margin too. And so maybe gross margin payback is a little bit better than even a cohort curve on retention. But it's definitely, there's no tried and true method. I would never back up the truck on anything. But if I had to start looking at a business, one of the first places I would look is there, but that's just the first step.
What I want to tell you about today is Parker credit cards. Look, there are multiple subreddits dedicated to credit cards points hacking, and I get it. But what do entrepreneurs really want in today's market? Help managing their payback windows when acquisition starts ramping. With Parker credit cards, you get up to 90-day repayments on ad spend to help you on your cash conversion rather than having all that upfront ad spend before revenue starts coming in. Parker allows you to spend aggressively while still managing cash flow, including meta spend. So instead of hunting for best points or cashback programs, realize that the best ROI is to be able to increase your ad spend without hurting cash flow. Go and check them out. Parker credit cards at getparker.com. That's getparker.com. Parker is a financial technology company, not a bank. The Parker Commercial Credit MasterCard is issued by Patriot Bank and a member of the FDIC pursuant to license by Credit Card International Incorporated. Let's just get really granular on where growth equity markets are in 2025. There's been a retreat, and which is why Asher's being greedy and kind of being aggressive. But yeah, like for a business that has nascent scale, let's call it in the maybe 5-10 range, but it hasn't hit escape velocity, but it's just kind of, let's call it CAGRing at the 20 to 30% mark. It's near profitability. Would your advice to them be, hey, be patient, continue to CAGR, or would it be, hey, there are still equity dollars, go and raise a larger round, try to take more market share, get to significance of 50 to 100 million?
Yeah, without knowing more, my bias would be the former, in that I think if you can not raise money and get to true cash flow, EBITDA, whatever you want to call it, profitability, I think that is probably the way that you can leverage, you can leverage that into raising more money if you wanted to. But before you get there, everyone's going to have that question. And I think you're just adding risk to the business by saying, oh, give me more money and eventually I'll get to the promised land, as opposed to, I'll define the promised land as 10 million of EBITDA, let's just say. I do think there is, a real difference in terms of strategic interest and PE interest once you get above that level. And so once you're there, you have a lot of options on the table. But until you get there, I would, if I were a founder, I'd try to raise as little as capital to get there, because I do think in the end, any buyer is going to appreciate the capital efficiency of the business and say, oh, if I were to put, me as the buyer of this brand X, if I were to put in even more capital, I could probably get even more juice out of it. Whereas if you just put all the juice into it that you ever can and put it on a silver platter for a buyer, they might just be like, I don't know what I'm going to get out of this thing. How much more can I really get?
You said something earlier that you think it's been underappreciated how much liquidity there has been in consumer, or maybe said another way, how much liquidity potential there is in consumer to return money. You spent a lot of time with the corp dev teams of large incumbents. Again, I think a space that's largely understood. What are corp dev people looking for? Size, velocity, profitability. Maybe share a perspective on that.
Yeah, I mean, I really think and this is another thing that me as an investor really focus on when I'm looking at a company, is the likelihood of an exit. And it really depends on the product and who the natural buyer would be. And so I do think there's a lot of research one can do around, okay, if this brand is successful, who would the logical buyers be? I think you're seeing a lot of interest in kind of supplements and kind of energy drinks and things like that of late. I'm not sure I would start the next one, but I do think there's a lot of interest in functional beverages, caffeine, that whole world. I put it as what fits with their strategic direction. I do think there's been an underinvestment in R&D of the large incumbents. They have chosen to just find what works from a product market fit perspective at the early stage. And I'd call 50, 100 million of revenue, ideally some profitability. And they're saying, okay, that's enough of a acquisition where this can really move my bottom line, or as a public company. So you've seen Keurig Dr. Pepper be quite acquisitive in energy drinks. And you've seen Pepsi be fairly acquisitive in snacks, because I do think there is an understanding that consumers want some new choices, and it's just easier to acquire a brand with that trust involved. I do think there's some people who get very nervous about these emerging brands selling to larger corporates and kind of blame, say big food or big pharma for some issues. And I kind of take issue with that. I think the consumer is actually really where people should be focused on, in that if Pepsi really believe consumers cared deeply about not consuming seed oils, they'll absolutely sell you a chip without a seed oil. There's nothing I can't imagine this person at Pepsi's we really want to use these other oils. But, a lot of people raise their hand saying, I want to use avocado oil. Okay, great. We'll buy Siete, $1 billion. And there you go. And now they can earn a great profit off Siete. So, I think any of these products, they can earn a solid margin for large companies. It's just a matter of them trying to figure out, okay, is that actually what people want?
Asher, is there a kind of within the enablement ecosystem outside of that are supporting brands, is there anything that you've seen that's kind of you've been excited about?
TikTok Shop still feels kind of a little bit like the Wild West to me, in that I think some companies, you're just seeing some examples of companies using it incredibly well and driving tons of volume, and other companies being like, yeah, we're testing out an agency here or there. So it feels like one where there's real, I don't know, as an investor, I'd say alpha, in that if you actually really invest in it and understand it, I think you can earn outsized returns relative to your dollars there. So that's one. We've seen some brands have a good experience with a company called Proxima AI in terms of finding kind of custom audiences in the D2C world. And for brands in the physical retail world, a product called Snowbiz, SNOBiz, is really good at linking up their data so they actually can see what's happening on the ground.
Yeah, awesome. Asher, as we head towards a wrap, what would be your biggest piece of advice for founders in 2025?
I'll keep this short because I've been verbose in some of my other answers. Don't compromise on quality. Build something genuinely differentiated and plan for little equity capital at the start.
I love that. Is there anything that you're seeking from listeners? Anything you're seeking from the universe?
I like that question. From listeners, yeah, send me any truly differentiated ideas to hello@rootspring.vc. And from the universe, I've thought about this recently a little bit. I would ask that people learn how to disagree respectfully. It sounds so simple, but it feels like we've lost this as a society. And my wife just told me that there's actually a class at Stanford for undergrads with the whole point of the class is to learn how to disagree respectfully. It's like as if college guys which don't really know what that means. And so, yeah, hopefully the universe can put that into people.
I love that answer. Asher, thanks so much for coming on, and look forward to next time.
Thanks, Dan. This was a lot of fun. Appreciate it.